Welcome back, subscribers, to my world of stocks, and welcome back to our Buy Heavy series, where I bring you a new stock that I am currently buying heavily myself on a major dip that I feel looks really attractive for the long term. And today I'm going with Realty Income, ticker symbol O. Now, obviously, whenever a stock is falling hard, there's going to be some issues and some risk to be aware of. So, as always, do your own research and make your own decisions. But for me, I feel it's worth the risk here, and I'll explain exactly why throughout this video. So let's jump into it. Okay, now if you're not familiar with this stock, it's actually a REIT, a real estate investment trust, which is actually one of the few places where I'm still finding a lot of value in the market right now. And I'll touch on why in just a second too. But REITs, of course, own real estate that they then rent out to clients or tenants. And then they use that giant cash flow from the rent that they collect to expand their business even further, acquiring more properties over time, as well as just returning some of those profits to shareholders, usually in the form of big dividends, which is why they can be so attractive as a holding, potentially generating big returns in the form of both the share price rising as well as the big juicy dividends. Well, in the case of Realty, they really used to be one of the most reliable, most attractive, and most desired REITs in the entire market, with a giant portfolio of over 15,000 properties worldwide, who it then collects rents from to pay out monthly dividends to investors, which are super attractive for more frequent and consistent cash flow. Unfortunately, though, the stock has been hit on two big fronts. One being their heavy exposure to retail, and the other being rising interest rates. The former being a concern given the retail apocalypse, with more and more shoppers choosing the online route every year, while the latter makes borrowing costs more expensive, which REITs rely on for expansion, while also making competing bonds more attractive given their rising yields, while also being generally considered as a safer alternative to dividend-paying REITs. That's making REITs a little less attractive, and it kind of hurts their stock price. As such, though, this stock went from really being a strong performer to now having fallen by about a third of their entire value from the top. But here's just three quick reasons why I think that they can recover greatly from here long term, specifically addressing those previous cons and risk factors that we just talked about. Now, number one, while Realty does have a lot of exposure to retail, they've also done a fantastic job of handpicking some of the highest quality tenants available, which has actually led to some incredibly strong occupancy rates that have literally never even dropped below 96% since IPOing in the early 1990s. That's incredible resilience for their business. And even managing to grow their funds from operations every single year through the dot-com bust, the Great Recession, the recent pandemic, and yeah, of course, the rise of e-commerce and the overall retail apocalypse, with strong growth also coming from their best tenants. And that seems to always offset the issues that they have from their weaker ones. So you can, of course, argue that it is, a risk factor to be aware of, but because of their size and strength, Realty has had an advantage, I would say, of being able to handpick the best ones that so far have performed very well for them. Number two is that while interest rates are high and tariff pressures linger right now, that's not always going to be the case in the future. Trade deals and resolutions will eventually get done, the economy will adjust to them, and interest rates will start coming down too. And once that happens, I just think REIT stocks in particular could go on a tear. Case in point, following the Great Recession, the Fed brought rates down to zero, and during that stretch, around 2009 to 2016, Realty Income stocks skyrocketed by more than 5 times their price. And so seeing that cyclicality in the stock, with right now being, one of the biggest drops ever, I just think it makes for a great buying opportunity. I just really feel like this is one of those moments where, I am supposed to be adding to the position here, which brings me to reason number 3, the cheap valuation, the very attractive dividend, and still the future potential. Because after the drop, Realty is now trading 13% cheaper than the sector on funds from operations, which is the main profitability metric used for REITs. So it's extremely attractive for such a large and well-established one like this to actually be trading that low, that cheap. Just as attractive, though, is also their dividend. In fact, I would argue that it's one of the absolute best, most attractive in the market right now that is available. Not only being paid monthly, again, as opposed to quarterly, but it's also been grown every single year since IPOing. That was more than 3 decades ago. This is actually considered a dividend aristocrat because of that. And because of the price drop, the yield has also risen to one of the highest levels, above 5.5%. I mean, usually it trades way lower than this. So seeing it at these levels tells me that it really shouldn't be here. It's not going to be here long term. This is really a level that needs to be corrected back down. And the only way to do that is for investors to buy into the stock, driving up the price and then lowering that yield. But again, the reason why they've been able to even pay such large dividends for so long at over 100 consecutive quarterly increases, the reason why I still have faith in this dividend long term is because their business model is really built around single tenant net lease real estate that actually carries much more favorable attributes compared to other real estate sectors like malls, offices, or even multifamily units, which in the case of realty, their tenants are actually the ones that have to pay for property taxes and all operating expenses. And that's huge because it means that realty isn't just bleeding cash on upkeep costs or, surprise expenses, but rather the tenants are the ones having to shoulder much of that burden. And it doesn't stop there. They're also responsible for capital expenditures. So if the roof needs replacing or the HVAC system dies, realty doesn't have to foot the bill for that either. That's a level of expense insulation that is pretty difficult to get in most other REIT structures. Plus, these properties are incredibly flexible, with vacant units being able to be sold individually, leased to a wide variety of uses, or even released quickly too, resulting in lower downtime and faster revenue recovery. And that agility is really a major reason why their portfolio stays productive even in tougher markets and economic downturns. Plus, realty is able to avoid messy co-tenant clauses that plague shopping centers and malls. If one tenant leaves, for example, it doesn't trigger a domino effect of rent reductions or lease renegotiations. And that stability is exactly what allows them to keep growing their dividends year after year, even during recessions. So when you combine all of that, the expense pass-through, the leasing flexibility, and the structural resilience, you're really looking at a REIT that's engineered here for predictable, durable income. And that's why Realty's monthly dividend isn't just generous, but is actually built on rock solid fundamentals, which brings me to my final point that, even with all the negatives in mind, with all the pessimism surrounding the stock right now, I actually think that their future looks just about as bright, if not brighter than ever before, as they work on expanding into new verticals like industrials, international, gaming, and even data centers that altogether should raise their total addressable market by several trillions more, at least according to their estimates. But, by the way, when those interest rates do eventually start coming down, I think it would, it's only going to make it that much easier for them to actually go out and make all of those necessary acquisitions and expansions and help them diversify further. So even though Wall Street sees realty as perhaps a more legacy type of retail heavy REIT at the moment, I just see so much more potential in them longer term. I see a world leader with a very low stock price, a dirt cheap valuation, a mouth-watering dividend, and even still some future potential to be had too. Time will tell if I'm right about all of this, of course, but for my portfolio, I think it's a great fit. So I'm buying at these levels while I still can. Again, it's just my opinion, just what I'm doing myself. You guys got to do your own research, got to make your own decisions. But let me know what you think about this one down below. I'd love to hear your thoughts, even if it's negative. It always kind of helps me with my investment decisions. If I can hear the kind of counter arguments to some of the things going on in my head, then it helps me make better, smarter investment decisions too. So I'd love to hear your thoughts, positive, negative, bring them all. I'd love to have a conversation with you about it. But hey, either way, I hope that you enjoyed the video. Hope you got something out of it. And if you did, please consider hitting that like button. If you want to support my channel, you can always do so on Patreon. That really helps a lot. Link in the description. But hey, thanks again just for stopping by, my friends. I hope that you're all doing well, and I will catch you in the next one. All right, take care, everybody. Bye-bye.